Welcome everyone to the Vested Interest channel. This is Shane, and in this video we are going to cover our weekly portfolio update. The portfolio is down slightly from last week, $442,829. We did add $942 in new capital, so we will cover what we bought this week, any options we were in, any dividends we received, any sales we made. No sales this week. We'll just get that one right out of the way. But if you are interested in this type of content, if you are a dividend growth investor or investing in general, hit all those buttons down below. Help me grow the channel. Make sure you make a comment. Share with anyone you think that might find value in the content. Doing all of that really does help out the channel. All right, let's jump right into it. No options this week. Actually, I did not even throw any out this week. I was pretty busy, so I did not get to it. I had some issues with I think it was because of the outages early in the week on Monday as well, so that was part of it. But typically when that happens and I don't get in on Monday, I go in on Tuesday and try to throw some out. But I did not. It is earnings season, so a lot of times I do try to stay away from options around earnings season. So maybe next week or the following we'll get back to it. Dividends, on the other hand, are another story. They continue to roll into the portfolio. So we did receive a payment from Comcast Corporation, ticker CMCSA, on the 22nd. $126.80. We do have the DRIP set, so that means or stands for Dividend Reinvestment Plan. So anytime a company pays out, or ETF, or if we had index funds, we have the DRIP set. So the funds that we get from dividends, like $126.80 in this case, gets reinvested right back into the same position. So we picked up 4.25368 more shares of Comcast, and those new shares added an additional $5.61 in passive income over the next calendar year. We received dividends on the 24th as well from Cisco Corporation, ticker SYY, out of the consumer staple sector. If I didn't mention it, Comcast is out of the communication sector. $84.07 we were paid by Cisco. And again, we do have the DRIP set, so those funds go right back in, pick up more shares, 1.07328 shares in this case, adding an additional $2.31 in passive income over the next calendar year. And when you hear people talking about the dividend snowball or compounded interest, this is what they're talking about, right? We own shares of Cisco. Those shares pay us dividends. Those dividends get reinvested. The new shares that we pick up add additional passive income that will get paid out towards shares the next time we get paid out, right? So 4 times a year, even if I don't do anything else, if I don't add any new capital, this position will continue to compound and grow on itself, on its own, without me adding any capital because I already own the shares. Now, obviously, if I add capital to this position, it will grow even faster. And the hill that snowball is rolling down is time. So the longer that this goes on, the larger that snowball will get. And again, there's a couple different ways that it gets bigger and faster. I add new capital, that's one way, right? We've already bought the shares, that's the first way. Adding new capital, that's the second way. The dividends reinvested, that's the third way. And then the company raising its dividend over time, that's the last way. All right, now on to the first new capital added to the portfolio. On the 21st, we did add $453.04 with those funds. We added to our Occidental Petroleum position, picking up 2 shares there, ticker OXY, out of the energy sector. Picked up those 2 shares at $41.20. Added 4 more shares to our VTI Properties position, ticker VICI. Picked up those 4 shares at $31.17. VICI is a REIT out of the real estate sector. Added 1 more share to our Owens Corning position, ticker OC, out of the industrial sector. Picked up that 1 share for $127.04. And 4 more shares to our Comcast Corporation position, ticker CMCSA, out of the communication sector. Picked up those 4 shares at $29.73 per share. The $453.04 and the new shares picked up with those funds added an additional $17.16 in passive income over the next calendar year. We were not quite done. We went back on October 24th, which was Friday, added an additional $489.87. And with those funds, we added to our weekly buys, VXUS, that's Vanguard's total international stock market. Picked up 1 share there, $74.91 per share. Added 3 shares to our Schwab Strategic Dividend Growth ETF, ticker SCHD. Picked up those 3 shares at $27.13. And added 1 more share to our Vanguard's total stock market ETF. That's the United States stock market, one share there at 333.57. And we add these every single week. Now, we might be making a little bit of a change to VTI because the market is, again, bouncing off all-time highs and seems to be on another run. And I have reached 100 shares of VTI. I might back off a little bit here, add it whenever there are pullbacks, maybe below my cost basis or over 5 or 10%. But this one, I do feel like the overall United States stock market is a little overvalued. Now, again, I did make it to 100 shares. We were adding all this year, all last year. So I'm comfortable with the position. I am going to continue to add. It will just be a little more selective. I would like it around 5% or more pullbacks, definitely below my cost basis. I'll be adding to it, or maybe I'll go every other week. VTI just won't be a weekly buy no matter what going forward. It'll be a little more selective. I will continue to add to the position whenever I feel like there's some value there. But I am going to continue to add to VXUS and SCHD every single week, regardless of the price. VTI, like I said, just be a little bit of a difference there. It might just be whenever there are pullbacks. But these new shares added $8.20 in additional passive income over the next calendar year. Total invested $942.91. Total passive income with the new shares added, as well as the dividends paid out, $33.28. Quick run through the sector weight. Communications makes up 8.34% of the portfolio. Consumer discretionary at 2.82%. Consumer staples makes up 7.82% of the pie. Energy at 8.79%. Financials makes up 6.39% of the portfolio. Healthcare still the largest position at 17.55%. Industrials at 5.60%. Technology there very close to healthcare at 17.48%, with Google and Lam Research running up. I would not be surprised if they continue to run up, if technology overtakes the portfolio here. Materials at 2.46%. Utilities makes up, 3.91%. REITs and real estate at 5.36%, and ETFs at 13.45%. Eventually, this will be the largest position or sector, just by the nature of adding to ETFs every single week. Now, you can see the same breakdown on the right here. Percentages matched up the pie here on the left, as well as the dollar amount allocated to each sector. All right, here it is, my overall portfolio. I do show this every single week. I think it's important for those of us in this space talking about investing to show you we are in the trenches with you. It's not just something we talk about. At least it's not something I just talk about. I am adding every single week. I am picking up new shares of individual positions as well as ETFs that I hold. So you can see here all of the different positions right here in this column. Total shares I hold. All of these numbers were updated yesterday on Saturday evening. Current price as of the close of business on Friday, really. Market value here, average cost per share, and purchase price. These do include reinvested dividends. Same thing with total return. If I'm up or down, you're going to see it, right? So right now, biggest loser remains Comcast, down 22.78%. We've been adding to that one while it's down. If I thought it was a good buy at $37.91, it should be a better buy at $29.28, so long as the fundamentals of the company are the same. And I don't see that the fundamentals of Comcast have deteriorated, so I'm going to continue to add. Might back off it a little bit now that I've run it up a little. It's currently 2.66% of the portfolio overall, so not a huge position, but we're going to add to it while it's down. Biggest winner, Lam Research, ticker LRCX here, up 107.47%. Google has really started running up 64.93%, right? Still down on Occidental. Pfizer is down. Procter & Gamble still down slightly. SCHD still down slightly. And Verizon is down. But AT&T has pulled back a little bit too. Still up 44.98%, but not up the 80-90% that it was. So we've got quite a few winners. We've got a few losers. That's the way it is in a real portfolio. And again, I think that's important for those of you out there watching the channel to see a real portfolio built out over time, especially those of you maybe who are on the fence about investing or are just getting started about investing. You are going to have positions go up. You are going to have positions pull back. Just because a position pulls back into the red, maybe below your cost basis, is not a reason to sell unless something is wrong with the fundamentals of the company, right? If they have collapsing revenue, their margins are decreasing, there's something wrong with the business overall. Their competitors have taken a better advantage, or maybe released some new products that they haven't. Maybe they've stagnated as a business overall. Then maybe it's a reason to, pull out of the company. They're going bankrupt or something like that. Obviously, that would be a good reason. But if the fundamentals of the company are the same and you're seeing a pullback, right, then those are the times to buy. Right? You don't run into a store and see a sale and turn around and say, I don't want to go in there because things are cheaper. But that's the way the market seems to work. People see positions pull back that are great positions, great companies, and they run away. They want to sell them because they've pulled back. And those should be the times that you are buying more and increasing your future returns. But that's up to you. You've got to make your own decisions. I'm going to keep doing what I'm doing, show you a real portfolio built out over time so you can see the ups and downs. And hopefully that helps some of you out there, again, especially new investors and those of you maybe on the fence about investing who haven't quite started yet. All right, here's all the sectors that the companies fall in here. Whether they're a quarterly, monthly, semi-annual payer, you're going to see it here. The highlighted yellow cells just means those companies have raised their dividends already on the year. LenB, actually, I don't believe they're going to raise their dividend. Looks like they may have paused their dividend, so a little disappointed there because this is a newer position that I picked up. This would be the first year in a while they haven't raised their dividend, so we'll see. Maybe they do it right there at the end of the year, and as we go into 2025, we see a new increased dividend, but not looking very good. OHI, they haven't raised their dividend in a while, but my yield on cost is so high at 9.125%. I'm fine with it. I'd love for them to start raising their dividend, but up 37%, and again with such a high yield on cost, I'm okay with that one. SYY, they've raised it. AT&T, I knew whenever I bought them, they had paused their dividend. Hopefully over the next couple of years, they start to increase it again. And really, that's the only three that haven't raised their dividend. So overall, still seeing nice dividend raises. Yield on cost in this column, current yield in this column, yield on cost here, portfolio weighting. So I do have a rule in the portfolio. I do not want any one position to be more than 10%. I do not want any one sector to be more than 20 to 25%. Estimated annual income here, dividend growth year over year. This does get updated, as you can see here. LenB, I put a 0 now since they haven't raised their dividend yet this year. I was hopeful that they would, but they have not, so it is what it is. Payout months here, where the company sits at 15% of a 52-week low. I do use this column and adjust my average cost per share based on where they sit at 15% of a 52-week low. So as that runs up, right? So let's look at Chubb, for example. My cost base is $281, or my cost base is $266.65. Current price $281.94. Obviously, the current price is above my average cost per share, but because it's still under 15% of a 52-week low, if I wanted to add to Chubb, ticker CB here, because it's under the $289.98 still, even though it's above my average cost per share, I could continue to buy up to this $289.98. That's how I use this column. I want my average cost per share to be below 15% of a 52-week low, and ideally, I want to be picking up shares below that 15% of a 52-week low as well. All right. Total shares held right now, 7,081.076. Market value of the overall portfolio, again, slightly pulled back this week, $442,828.82. Purchase price, what I have into the portfolio, including reinvested dividends, $370,353.73. Total return, I am up $72,475.09, or 19.57%. Nice to see. I do not focus on this. I know a lot of people, that's all they focus on is total return, which is fine. Everyone has their own strategy. But for me, total return is not the end-all be-all. Why? Because unless I sell all of these positions, I do not lock in this total return. I cannot get this $72,475.09 unless I sell everything, right? That's the only way to do it. Up 19.57%, mentioned that. All right, portfolio salary, $1,101.83 per month. Per week is $254.27. Per day, I would receive $36.22. And these are on average. Obviously, I'm not getting paid out every single day, but if you broke down the overall dividends for the year. And then per hour, the portfolio is generating $1.51. Current yield is at 2.986%. My yield on cost is higher than that at 3.57%. And this is what I focus on That is why it's circled over here in red. The dividends paid out by all the positions in the portfolio, and it continues to grow week over week, month over month, quarter over quarter, year over year as I add new capital, as the positions in the portfolio raise their dividends, as they pay out dividends and they get reinvested, and it currently sits at $13,221.90. So very nice to see that continual growth. I don't know if we're going to get over 14,000 per year by the end of the year, but it's going to be very close. Hopefully we do, but might not quite get there just by the nature. I have pulled back on my overall investing. I used to invest around $1,400-$1,500 a week. We're down around $800 to $900 a week, under 1,000, been pretty typical. Don't know if I'm going to quite get there. We'll see. Hopefully we get pretty close. But doing the math here, around $30-$40 a week won't quite get us there, but it'll get us very close. And if we don't bust over 14,000 a year, it will be in the first month or two of 2026. All right, dividend growth year over year of 5.31%. I do adjust this as the companies in the portfolio adjust their dividend payouts. All right, that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Drop a comment down below. Let me know what you are buying. What are you adding to in your portfolio? I know a lot of positions have really run up. Again, the overall market seems to be on another run. Part of the reason I'm probably going to back off of VTI a little bit, but we'll see if it was to pull back again below my cost basis, or a 5 to 10% pullback, and obviously above that, then I would look to add a little bit more, and I may look to add it every other week regardless. We'll see. I reached 100 shares, which is really my first goal. I do want to continue to add to it overall, but I do feel like the overall market is a little overvalued right now. Has been for a while, really. Now, let me know what's going on in your portfolio. What are you buying? What are you adding? What dividends did you receive? What options are you in, if any? Maybe you run options on the same position every single week. I usually look at the positions that are really run up. So like Lamb Research, I'll probably look to run an options call on. Google, maybe I'll look to run an options call on. Kroger, I think, is really back up there, 70% up. So I'll look to run one there. I really look at the positions that have really run up, that if they were to be called away, I wouldn't be mad about locking in a gain on those positions, right? So we'll see, but Lamb Research definitely, probably, I'll look to add. United Healthcare would be another one there. So let me know what's going on in your portfolio. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for tuning in. Thanks for stopping by. Hope you have a great weekend, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion. Invest during educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice, counsel, a certified financial advisor.